I won't do a lengthy introduction of Zach, as we have a lot to talk about, but certainly appreciate his being here. I wish we could just recreate the conversation we had over coffee a few minutes ago, which was super interesting to me. I will note one thing about Zach, which is that he is a new father as of 3 months ago?
6 months.
6 months. Okay.
Time flies, though.
I was going to say he just came here to get some rest, but it turns out he took the red eye, so there's no rest for the weary.
If I start stumbling over my words, that's why.
Yes. But anyway, it's I think, Zach, obviously founder of Plaid, which is in a very interesting place, I think, in the payments ecosystem. And so we wanted to talk first a little bit about Plaid, then a little bit about the ecosystem. And then since we are all about policy, a little bit about 1033. I think it's fair to say he's a bigger fan of the rule than I am, but that'll be fun as well. So you just celebrated, I think it's your 10th anniversary, which congratulations on that. That was last year. So just maybe a little bit about the evolution of Plaid. I know you started off as something a little different and became something amazing.
So it's been a little bit more than 10 years that we've been building Plaid, the current product, as you more or less know it today. Prior to that, we actually spent about a year building consumer products. So in kind of the 2012, 2013 timeframe, it was kind of towards the tail end of Occupy Wall Street. Kind of the recovery from the 2008 financial crisis was very well underway, and yet consumers still felt incredibly frustrated with financial services. They felt like they didn't have access to the products that they would want to have access to. If you think about banking in 2012, 2013, if you wanted to do almost anything in your financial life, you had to walk into a bank branch and talk to a banker. So you want to open a new account, you want to get a replacement debit card, you want to apply for a loan, you want to get a credit card. A lot of that required walking into a bank branch and talking to a banker. Now, credit cards you could do over the mail, but the rest of it required you to walk in. And I grew up in kind of small town North Carolina. Not a lot of banks in our town. There was really only one bank in the town I grew up in. And that meant that a lot of people in our community didn't have access to the financial products that they needed or wanted. And so we started out by first trying to build digital financial products. So we created budgeting tools, expense management tools, spend tracking tools. It turns out the consumer product for us never really took hold. But we found a really important underlying problem, which was that there wasn't infrastructure to permission data into an application. So if you wanted to use kind of an online budgeting tool, how did you get data into that online budgeting tool? Well, that didn't exist. And we'd built a lot of that on the back end, and then that's when we kind of pivoted into what Plaid is today. Is it helpful for me to give an overview of what we do now?
Oh, sure. Yeah.
So the theory for Plaid is we want to create an API for your bank account. We wanted to make it really simple to link your bank account to any application out there on the web. Put even more simply, on one side of our business, we integrate with about 12,000 banks across the US, Canada, UK, and Europe. Those integrations, allow us to take, kind of collect data and take action on behalf of a consumer when the consumer permissions us to do so. And then our customers are customers like, let's take Venmo, for example. The way that you link your bank account to Venmo, that's the infrastructure that we build. So that bank linking, that was the majority of our business up until about 3 years ago. And the last 3 years, we've heard customers ask us to build stuff on top of the data that's coming through. So they wanted fraud analytics or credit analytics or kind of the ability to set up and execute ACH payments. So we've added a lot of these tools that sit on top of the underlying bank linking recently.
Actually, we were just talking earlier about, I had not known until recently that you actually now have a credit reporting agency as part of Plaid, I guess, as one of those add-on products. Maybe just talk a little bit about that.
Yeah, absolutely. So it was a little bit over a year ago that we launched a consumer reporting agency subsidiary. This is after lenders had been asking us for 4 or 5 years, hey, can we use transaction data? Can we use bank statement data to make loans on? We ended up, before we had the CRA, building a bunch of verification products, so things that would allow a lender to verify your income or verify your asset levels. If you're applying for a mortgage, the mortgage lender might want to know that you have $50,000 in stocks in a different account. So that's what we started with. But eventually, the lenders continued to ask for this concept of, can we build a cash flow prediction? Can we project how much free cash flow you have? Can we project kind of what income levels you'll have at some point in the future? And that's a hugely useful insight for a lender. All of a sudden, they can lend to people that maybe have high income but no credit history, or recently came to the U.S., have a lot of assets, have good free cash flow, but again, don't have that credit history. And so we launched an internal consumer reporting agency subsidiary, and that's been kind of a great unlock for us to be able to launch these products and scale them up. Initially, it started with kind of non-bank lenders, but increasingly we're seeing more and more banks actually buying these products and getting interested in the space. So, yeah, it's been a really fascinating tailwind for us.
I'm sort of curious actually about sort of the regulatory end of that, because that means adverse action notices, things like that. I mean, what do you have to tell customers when you're doing cash flow analysis? You're not really doing a denial, you're passing that on to someone else. So what's the regulatory barnacles on your credit reporting hall?
Well, there's a lot of aspects that come with being a consumer reporting agency. I think like the core process is that we want to create it such that a consumer has the ability to assemble and then review their own data before they submit it to the lender. So they actually get the ability to go through and say, you know, I'm not going to submit that if they were to choose not to. And then once they do submit it to the lender can then make the decision based on that. So we kind of follow the standard FCRA process for it. I would say in a lot of cases, or at least where we started, was that lenders were coming to us to say, hey, I want to be able to give additional qualification criteria to a consumer that might not have either a FICO at all or might have, you know, a very thin file. And so that's kind of where we've been starting, but it's starting to scale up, and I suspect that, you know, one day it'll be able to stand alone.
Cool. Sort of related, and certainly a focus for us has been the wave of fraud sweeping America. Interestingly, to include check fraud, which is not your problem, but all types of online fraud as well. I know you have your Beacon product or subsidiary, whatever that is. And obviously the data flowing through your pipes is of a lot of use in that regard as well. So can you talk just a little bit about how you're combating the fraudsters?
Yeah, well, I mean, fraud it's an ever escalating battle, as all of us know. And it's something that the fraudsters are oftentimes faster at using the new tools than the fraud detection or fraud prevention companies. So we're trying to change that. The interesting thing about the fraud space is that it's a collaborative game. So there might be 10 different fraud companies out there, and chances are it actually makes the most sense for you know, a bank or a fintech to buy kind of inputs from all 10 of them. So it's not something where if you add another fraud data point, you're going to necessarily remove the rest. You change your weighting, you figure out what kind of thing you're trying to protect against. And so from our perspective, we recognize that we have a relatively unique data set and relatively unique access. And so we wanted to add kind of another data point into the array of things that customers could use. The data points that we have are, we see all the flow of the accounts that are being linked. We understand the data that's passing through that. But crucially, we also have integrations into, you know, thousands of fintech companies. And as a part of this fraud tool that we have, it's called Beacon, the fintech companies are actually reporting fraud back to us. So if, let's take Venmo, I'll pick on them since we already used them as an example. If Venmo saw fraud and they're a Beacon customer, then they'll actually tell us the user account on which they saw fraud. We'll then anonymize that such that they don't know that it comes from Venmo, but we'll federate out the fact that this user account saw fraud on it and the type of fraud that it saw across our entire network. And so the cool part is we have this really unique signal coming from all the fintech companies that really hasn't been collected. And then we've, of course, augmented that with tons of other kind of internal and external data points. But it's been a fascinating space for us. Like credit underwriting and kind of fraud analytics, those are the two major areas that we're investing in for the coming year.
Is that, to some extent, does that ever bring you sort of in conflict with some of your customers to the extent they want to offer these services, or they're more just focused on the pure lending side? Or I guess, you know, if you're thinking about a PayPal or something, they want to manage, you know, small business relationships and things like that and be their portal for payments. So you're not really in competition with them?
You know, our competitors are relatively few. Like philosophically, we want to make everyone into a partner or a customer as much as we possibly can, even those that are direct competitors. We'd much rather have them as partners or customers. And so, you know, when it comes to PayPal, like PayPal's you know, customer, we talked about Venmo already, and you know, they would actually be using that kind of signal. I think where it creates a little bit of tension with our customers is that, you know, let's say we're working with a kind of fintech lender and they developed a really unique kind of cash flow based lending algorithm, and then we built that as a product and offered it to all their all their competitors. I mean, yeah, that would maybe frustrate them, but again, we've been really clear that our role in the ecosystem is we want to build tools that anyone can use that increase access for consumers and that kind of increase the number of great fintech products that are out there. And so it wouldn't be a surprise to them that we would build this kind of credit algorithm, but importantly, we don't directly compete with our customers.
Interesting. Just to check one box. So when I first heard of Plaid, it was data aggregator screen scraper, which is the dirtiest thing you can say about somebody. Screen scrape. Screen scraper. It's
if
even
that's the dirtiest thing you've ever said about somebody, you're really an excellent person.
So are you still scraping screens, or have you evolved your business?
Yeah. So first, maybe just in case people don't fully understand what screen scraping is and how it works. Screen scraping is basically collecting data off the website. Before APIs really existed in financial services, the only way you could get your bank transaction data or your bank statement data into, let's say, a budgeting app is to log into your website, grab the data that's on the website, log into your bank website, sorry, grab the transaction data that's on the bank website, and then kind of pipe that over to the application. Now, when we started, Plaid was 2 people. And we knew the theory of what we wanted to do. We'd actually, interestingly, read the 1033 regulation, so knew that it was possible for us to do this. But we went to the banks and first said, hey, we'd love to build an API, or we'd love for you to give us access to your API. And the initial reaction we got was, who are you? Why are there 24-year-olds in my office? And what is an API? And it's not to say that anyone was poorly intended. That wasn't the lexicon of what anyone was thinking about. So what we did was we built these screen scrapers to collect data on behalf of the consumer, pass it back to the application they were trying to use. We had first hundreds, then thousands, then eventually like millions of consumers that were using these fintech applications. And eventually the bank started to understand what it was. And it's not as if it was a super straightforward set of conversations, but as we went through these conversations with the banks, we got to a world in which basically all of the large banks, I think all of your member banks and many more, had actually stood up and launched these APIs that we plug into. So at this point, the large majority of our traffic is running through APIs, but there are still thousands of small banks that don't have the infrastructure or ability, frankly, to launch APIs, at least not fast. And so for those, we still do screen scrape. I think it's something like 80% of data comes through APIs and 20% comes from scraping. We can talk about 1033, but my hope is that as all of this world starts to get more and more normalized, that more and more banks will have APIs, and we'd love to do that. We've built API builder platforms. We've built tools to help the small banks launch APIs. We've partnered with tons of the industry players to try to get those APIs out there. But ultimately, it really matters to us that any consumer at any bank is able to use fintech, able to use digital finance products. And so while we prefer APIs everywhere, sometimes we do still have to scrape.
Well, actually, I mean, on 1033, it is a little bit of a question in the sense that, I won't be too judgmental. I mean, to the extent that the larger banks that tend to be BPI members are already using APIs, and the CFPB has chosen to exempt all banks under $850 million from 1033. I mean, from a Plaid perspective, what's the value add of 1033 if all the folks who are subject to the rule are already doing APIs with you and all the people who aren't are exempt from the rule? So what's so good about this from your perspective?
Well, let's see. I'll make a couple of general comments. So you are correct that all your member banks. I think a lot of banks that aren't member banks but are still large have free APIs where consumers can collect their financial data and kind of put it in the place they want it to go. So that's great. You are correct also in saying that sub 850 million in assets, kind of the banks are exempt from 1033, which it's a bit of a bummer in some sense, but I think that all of those banks would still want their consumers to be able to have access to the financial products that 1033 enables or fintech broadly enables. So for us, that's still a priority. Like, we're still going to focus on working with every bank. We still want every consumer in the U.S. to be able to have access to the products that they want to, and we'll continue to push that forward. I think 1033 is quite positive for a number of reasons, but most specifically that it really solidifies the concept that consumers should and will have access to their financial data, should and will be able to use the applications that they currently use even today. Most consumers use fintech in many senses. I'm guessing you use fintech in many senses. People use it to live their financial life. As we were going through COVID, the thing that we heard all the time is that consumers said it's a lifeline to be able to use these digital financial products, and that hasn't backed off. Actually, usage has increased since then. And so, in a lot of senses, 1033 is just a formalization of the kind of fintech economy as it already exists. I shouldn't say fintech. I should say digital finance. When I say fintech, people think about non-banks that are building products. I really mean digital finance, which includes the banks themselves, who are, in my opinion, the biggest fintech companies. So like a solidification of the fact that this is really important, I think is really true. Now, there are things that, were I to write it, I might have emphasized or changed, but on the whole, I'm very happy with the direction.
So for those covering this, Zach, harshly critical of 1033, I think is the,
quite
is the
positive
headline right here.
As with everything, there are opportunities for improvement, and it'll continue to evolve.
Yeah. Well, actually, interesting. I mean, with regard to those smaller banks, I mean, I assume you actually don't really deal with them. Don't you deal with the core processors who are effectively doing that for them, or?
All of the above. Actually, we work directly with the small banks when and where they can, when and where they want to. We build, as I said, API and integration builders for the small banks, and they can plug into it themselves directly, and many of them do. We'll work through the core processors. We'll work through other platform providers. We have a whole host of partners that also sell products directly to them to help them interact with fintech better. So our view is we need to get to every consumer in the U.S. Sorry, not only every consumer, but every consumer and every bank account in the U.S. And we'll work kind of in all ways available to us to do that.
Okay. One truly disruptive thing that I think you're participating in, which has always been very interesting, is the notion of pay by bank. Maybe you could just describe pay by bank, and then, well, we'll do 3 parts. Describe pay by bank, sort of who are the winners and losers in pay by bank, and then sort of what's your role here?
Sure. So pay by bank, when you hear the words pay by bank, everybody assumes that you walk into a Starbucks, you somehow use your bank account to pay for the coffee that you're buying. Realistically, pay by bank is focused on a much broader swath of things, and if I'm honest, I think it's going to take quite a long time, if ever, to get to that Starbucks purchase. So pay by bank is about kind of using your existing bank account to execute a payment or a funds transfer in order to kind of buy a good or a service, or kind of move money to the place that it needs to go. How many billion checks were processed last year?
Lots.
Yeah, lots. Lots of billions of checks were processed last year.
Actually, check usage not going down, interestingly, the last couple of years.
Yeah, it went down for a while, and it's kind of hovered.
Yeah.
I mean, a lot of those are B2B checks, but frankly, a lot of consumers are still paying for things. And I think that when you talk to anyone in the financial industry, they would say the less checks, the better. Because frankly, it's a lot of processing costs, it's a lot of overhead.
They would say the fewer checks. I went to Carolina, he went to Duke. I just had to take one shot. Sorry.
Say what you will. One of us was on a plane last night. One of us wasn't. Sorry, my
made him blush.
My comms team is in the audience. They will never let me live that down. So thank you. All right, fewer checks. Everyone would like fewer checks. So when we think about pay by bank, linking a bank account, executing an automatic ECH transaction or an RTP transaction or a FedNow transaction or whatever it is, that is way better for everyone. So if you can imagine paying your utility bill, instead of writing a check in every month, you link your bank account, you have an automatic draft that goes through. I think that everyone will say that that is progress. It's simpler for the utility provider. It's probably cheaper and less complex for the bank. And for the consumer, it's something that they don't have to do every single month. So pay by bank is, yes, it's setting up utility bills. It's enabling B2B payments to run digitally instead of over physical checks. But you could also use it for retail purchases. So, I think that when you consider how pay by bank will work, my hunch is that it's going to start with the areas that are under addressed, such as replacing checks or high dollar value purchases or utility bill payments or subscriptions, things like that. And I think it's going to be quite a long time before pay by bank gets to in-person physical commerce. Mm-hmm. But people tend to hear pay by bank and they assume it's going to replace everything. And my point is it's going to be a slow evolution in the areas that need it the most.
Well, I mean, I think the sort of the Rubicon to cross on pay by bank is, I mean, I don't even think, it's so normal now to do a lot of things by ACH, you don't even think of that as pay by bank. I mean, I think when people worry or think, oh, it is. No, I agree. But when they think about, pay by bank, it's now, will that ever migrate to retail, to displacing credit cards, for example? where whenever I make a purchase, I try to use my credit card because I'm a transactor and I want to earn miles. So that's sort of the question is, can you make that leap where it's truly disruptive to the Visa MasterCard model?
Totally. I mean, I guess my response to that is, why even try to go after those things where Visa MasterCard works really well? I use Apple Pay to pay for my Starbucks transactions. That's incredibly simple. Like, I have no reason to change off of that.
Well, saying you use Apple Pay, and we won't get into their monopolistic tying practices, but there's actually, that means you're using a card that you have downloaded into their wallet, since they won't let their bank have a wallet on their phone. But I mean, when you do that, are you using a credit card or a debit card?
I'm using a credit card when I do that usually.
Good for you.
One of your member bank credit cards, most likely. So if Apple Pay is that easy to buy the coffee at Starbucks, so I have a 6-month-old daughter. I don't pay school tuition yet, but when I do pay school tuition, chances are that school tuition is going to have a 3% surcharge on it to pay with a credit card. And if they also offer the ability to link a bank account and pay over ACH or RTP or FedNow, then I would be highly incentivized to actually try that. And so I think that those are the kinds of use cases. When you talk about competition with credit cards, it's going to be in those kind of surchargey, like high dollar value type of use cases that I suspect that we'll actually see meaningful competition. But in the in-person retail, I really think it's going to be quite a long time if ever.
Yeah. Well, I was surprised. I mean, I think one of your notes, I think it was your threads. Is that your annual thing?
Yeah, we rename our customer conference every year. So this year it was called Effects. Last year it was called Threads.
Oh, I got it. But I think you had a number that with a 1% cash back, the merchants were able to increase pay by bank by 20-30%, which seemed high to me.
I mean, the reality is, like any incentive to a consumer, yes, will change their preference. It's a question of like, how do you structure the incentive best? Is it a one-time incentive? Is it a long-term incentive? Look, at the end of the day, again, like when we think about pay by bank, there's a huge universe of things that need to be addressed to get us off of checks or get us onto more modern payment mechanisms. That's really where we're looking first. Over time, could it compete in kind of e-commerce? Perhaps, but I really think it would only compete at the edges, the high dollar value areas. That said, our customers can build anything they want to with Plaid, right? And our role in all of this is we're the infrastructure provider, and we enable them to create these interesting use cases. I'm fascinated to see what they come up with. Maybe they'll come up with something that I couldn't think of today. So I'm excited to support it if they do.
Okay. Well, speaking of infrastructure, I also saw that last year you integrated the clearinghouse's RTP into your transfer function.
We did.
And just sort of curious about, I mean, I think, adoption for RTP has not been, alarmingly high. Of course, higher than the failed FedNow product, but still not super high. And I think one of the reasons for that is that it's at this point just a lot more expensive than ACH, certainly 3-day ACH, and maybe even 1-day ACH. Although I think that's getting a little closer. So when you think about using it, what was sort of the pricing consideration there?
So I mean, again, like our philosophy is that we want to build tools that our customers can use and kind of create an open platform so that they can use them however they want to. RTP, we've seen a lot of value in terms of payouts. So platforms that need to pay out to a customer. Let's take a marketplace, a used goods marketplace. If I sell something on a used goods marketplace and the marketplace needs to pay me quickly, like how can we enable that? They want to use RTP to pay out, and that's been an area of excitement for our customers. I think that RTP could move a lot faster, frankly, if they had requests for payment or they didn't block commerce use cases or so on and so forth. A lot of the decisions that they've chosen to make. I am excited for the continued rollout of FedNow. I actually think that as with many things, competition is a good thing. It'll lead to more iteration and more optionality for consumers. So we're excited to hopefully see FedNow continue to roll out. Though I hope it accelerates a little bit. And
I assume you'd be supportive if the government wanted to establish a business to compete with Plaid. Since you don't have a lot of competition, maybe they could just start something up at one of the reserve banks.
You mean like a group of banks getting together and creating a competitor to Plaid and making some interesting decisions on what they enable for the ecosystem versus what they enable for that specific competitor that they own?
Yes. Good times. The Carolina Duke stuff's really coming out at this point. This has been a lot of laughs. I guess we got to talk about 1033. We kind of did, but I mean, how do you? I mean, this sort of gets back to the question I asked earlier, but maybe I'll be more direct. I mean, how do you see it actually changing the landscape in a world where we've already evolved to APIs? What's going to be the other than banks having to provide their services for free under the rule? But aside from that, what's going to be the difference, you think? Assuming it's upheld in the courts.
Well, first, I'll note that the banks already do provide the services for free, and even prior to them having APIs, they provided bank statements for free. They didn't charge a consumer incrementally for a bank statement. This is basically the same thing. But setting that aside, I think in a lot of senses, we've been fortunate in the US to be able to build an incredible fintech ecosystem, an incredible digital finance ecosystem that works really, really well for consumers in the anticipation of a rule eventually coming, but before the rule itself already existed. So if you look at Europe, they put in place open banking regulations. They put it in place before the fintech economy really existed, before the fintech applications existed. Yes, there were some ideas. Yes, there were some early companies, but the regulation really created the ecosystem. And it's led to, in some senses, a lot of chaos. I mean, it's led to value, certainly, but it's led to a lot of chaos. And now they're iterating on the regulation already. They've done PSD2, now they're going to do PSD3, and eventually, like the regulation and the needs of the consumer in the market will start to match up. But it's taken a lot of work to get there. I think we're actually fortunate in the U.S. that there was directionality, and people understood that consumers should own their financial data. They should have rights to their financial data, and there can be applications built on top of that concept of digital financial data. And if the regulation just seeks to kind of like reinforce the thing that people already expected, that may well be an excellent outcome. Now, you have your differences with some elements of 1033. Look, I wish that there were other things in here that that the rule was slightly different in a couple ways. But on the whole, if the outcome is that the ecosystem as it kind of works now continues to work, I think that's a huge win for consumers.
Cool. Well, actually, you mentioned Europe, UK. I mean, any plans? I mean, Plaid actually sounds vaguely UK-ish.
we're in the
tartan or something.
We're in the UK. We're in Europe. 17 countries in Europe. It's been fascinating learnings. As I said, it's a very different ecosystem there. A lot of the kind of data use cases are much less emphasized. A lot of the payments use cases are much more emphasized for a whole host of reasons. But a lot of learnings from Europe for us, and then we are kind of in the process of trying to bring many of our existing products in the US, specifically our credit and lending products, over to Europe so that we can launch and scale them up there.
And do you find sort of the regulatory and business environment similar? I don't know a lot about European fintechs. I assume there are fewer, but how is it different operating in Europe versus US?
It's different in a lot of senses. First is just purely from a consumer behavior standpoint. So we talk about pay by bank in the US, and it's kind of a not novel concept, but it's not incredibly common. In Europe, it's very common. And so kind of that concept is very different in terms of how consumers behave. Again, the regulation drove the market as opposed to the market driving the regulation. And so you saw a lot of people kind of have this like immediate hurry up of like, we all have to launch like a very similar thing super, super fast because this regulation has changed something. So there's a lot of whiplash there. Frankly, the markets are smaller as well. Yeah. So you see a lot less banks, kind of a lot more concentration in the markets. And I really love the pace of innovation that we're seeing in the US. I think I joked for a while that Europe was leading in terms of fintech innovation, and I think that the US has really caught up.
Excellent. I think that's our time.
Yeah. Thank you for doing this. This was fun.
It was really fun.